Let's show you the markets. You'll see exactly what I'm talking about. It really didn't look like that, but 10 minutes ago was red, flat-ish. Now we've gotten a nice move kind of everywhere in the market. So there are questions about the durability of the ceasefire. I think everybody can understand that. Even so, there are some folks like Fundstrat's Tom Lee who say enough positive things have happened that the worst is clearly behind this market. Here's what he told me yesterday on Closing Bell. Listen.
The bottom's in, Scott, because last week was a period where the war was getting worse and oil was going up, but stocks weren't going down. So that's a good precondition. And today now we have the rate of change, that the war is de-escalating. So I think stocks are now in the process to go back to their all-time highs.
Okay, so we'll go to Josh Brown first, who looks to us today to be doing his best Rodney Dangerfield back-to-school moment at the University of Miami, better known as the U. What do you think? I mean, I don't know. It's like you have to address the backdrop. What are you doing?
I am at the Herbert School of Business at the University of Miami, which is celebrating the fact that they have just broken into the top 40 business schools in America for the first time, well on their way to a top 20 business school in America. So,
okay.
But let's address the issue at hand. I think what Tom said is spot on. When you have continued bad news and stock prices stop reacting to it, that's a wake-up call for people who have been pressing their bets on the short side, that maybe they might be overstaying their welcome. Last week, we saw an explosion in people buying puts. We saw a huge move into cash in a lot of areas of the market. And I think we got to the point where we had sufficiently beaten up multiples for growth stocks. And we'll talk about some of the Mag 7 names in a minute. But people just looked at that and said, okay, I get it. This conflict could drag on. Maybe it doesn't. It's impossible to know. Even the people most responsible for the decision making themselves do not know. But here's what I can tell you. Earnings growth revisions are still trending higher. Analysts continue to take their numbers up. The first few companies that we got had nothing but good things to say. Look at the Delta news about what's happening with corporate customers, regular households, consumers. And it's enough is enough. And I like that backdrop. I wouldn't suggest to you the bottom is definitely in, but if I had to bet one way or the other, I would bet we have substantially digested a lot of the negatives, and now we're going to hear some great things from companies as they report. So I said this on Tuesday, the amount of positive pre-announcements looks great. The amount of negative pre-announcements is really low. And here we go.
Yeah, well, I mean, here we go. The market's clearly going, as you see. The S&P is only 2.5% away from its all-time high.
Yeah, it's amazing.
Feels crazy to say that, given everything that we've been through. I know, the ceasefire development was enough to give this market a big bump. This latest news that we're showing you on the bottom of the screen here regarding the Israelis and Lebanon, that has moved the market in the last several minutes. What do you think about what Tom Lee had to say and now how this environment looks?
So yesterday I was in Washington, D.C., and I had one for the client. And to your point about, it's only down so much, I said, improbably, unbelievably, your portfolios are still in good shape. I think it stuns everyone when they look at the actual numbers and see that the market's essentially flat. Lots of strategies are actually up. So with Tom Lee's comments, I think he's right. I just come at the same perspective with a slightly different path to getting there. I think we got very close to the brink. I think we looked over the edge and we didn't like what we saw. And as an investor, what I bet on is I bet on President Trump's self-preservation tactics and instincts. And I think when we were at that ugly point on Tuesday night, nobody wants to see oil go to 200. Nobody wants to see the Middle East get any worse. That's worse for everyone. So so where we are is backing slowly away. I agree with Josh that the bottom may not be in, but I also think that our worst case scenario is a lot less bad than it used to be. And and I'm working on my client letter, and you know me, Scott, I generally skew negative, right? So I'm writing this letter and I'm working on my outlook, and it's frankly kind of hard to skew too negative, because what you have is earnings that are expected to grow 16% this year over next year, earnings that are expected to grow another 16% in 2027, and interest rates that, while they might not be going down, they are unlikely to continue to go up. And at the bottom of all that, at the bottom of the market is interest rates and earnings. And you have a consumer that, you know, I'm skeptical about the health of the consumer. We're all on board with that. It's a K-shaped economy and a K-shaped consumer. But you hear comments from Delta and Levi's, and they're saying, look, the consumer is still in okay shape, particularly the high-end consumer continues to grow. So even I'm not that dark in this moment. Wow.
Kevin, timestamp this moment.
Thank you.
Please.
But I'm not buying Apple yet.
That's
so
all right.
It's not too crazy.
This is a historic moment in the anthology, in the history of this program, that something has occurred, that Jenny Harrington is now
not that dark.
The sun has come out, ladies and gentlemen. What can I say? Malcolm, what do you think? What do you think about where we are here? I mean, feels like the market is now looking for an excuse to go higher.
Yes.
All you need are some consistent headlines and feeling better about the broader scenario of the Strait and peace talks.
So I think Josh and Jenny have put a lot of technical reasons around this and given it some very good sounding reasons for why this market wants to go higher. Frankly, I think it's just the FOMO trade. It's literally the knee-jerk reaction to, we learned our lesson with Liberation Day. We saw the NASDAQ go up 10% in one day, basically, when we got the all clear via Twitter. And no one wants to be on the wrong side of that trade. And so whether it's too early now or we're very close to this finally being the ceasefire that ends it all, no one wants to be wrong and no one wants to miss out on that trade. And we can see it based on what people are buying right now. The only thing that's, I think, going to matter here is tech and financials, because that's where the opportunity is. Those are the things that have been sold off the most. And that's what everybody's crowding into at the moment, trying to right size their portfolio holdings.
Not everybody, I guess, is on the same side of the bullish boat yet. Jim, like Piper's Craig Johnson says, not convinced that the market's out of the woods. And he points out that, at least in his mind, to maintain a new bull cycle, it's going to take a combination of things, namely crude oil retreating to its around $70 and a significant decline in yields. Now, yields are moving lower. I thought Jeff DeGraff yesterday on Closing Bell was quite interesting in suggesting that he as well wasn't exactly buying the big back bull case yet until yields came down further, took a little of the stress off there. Now, that is progressing in the direction that you would like to see. I think people would feel a lot better if you got back around 4.25. No, we were almost at 4.5 a couple weeks ago. At the real height of the conflict and the tensions, it felt like, oh boy, yields are backing up. This is now a double problem for this market.
Right. It got dangerous for a second, but not for very long. I mean, 4.5%, you go above that, and generally the markets have had trouble with it. But even so, it wasn't there for very long. We've been hanging out in the 430 to 440 range, even in the height of the hostilities, which frankly was not too bad of a level. But yes, the markets, of course, like slightly lower yields here. Just to summarize, I think we can say the bottom's in because hostilities have gone down. And both sides seem to want to take an off-ramp in some direction or another. Is it going to be a perfect ceasefire? No, of course not. There's going to be hostilities continuing, but it doesn't look like they're going to get worse. Where I think we have to be careful, though, is I don't think the volatility is over. So I think Josh alluded to this maybe, and sort of what does the bottom look like? We can rattle around at this level for a little while, particularly as we get into earnings. Yes, we're going to have excellent top-line growth from technology. We're going to have good earnings from energy, but there are going to be some sectors that are going to feel the heat from higher energy prices, and that will just create volatility. So if you're looking at the market right now and saying, oh my God, I've got to dive in right now, you can take some right now. You can buy some, but leave some dry powder. There will be volatility. And we're going to set new highs this year, but there will be volatility in the short term.